Hi, everyone. I'm DeFi Dad. You're watching episode 43 of Yield TV. Hey, so we're back. It's Monday, December 7th, 2020. And today we are going to talk all about DeFi insurance with the founder of Nexus Mutual, Hugh Karp. Hugh, welcome to Yield TV. How you doing?
Yeah, thank you. Great to be here. I'm doing really well, thank you.
Yeah, so we're going to help to explain in the next 30 minutes what exactly Nexus is and how smart contract cover works. And also you guys have this new custody cover, so I can insure my crypto assets lending with popular custodial services like BlockFi or Celsius. But first, we probably should talk about that background of Nexus. So just very quickly, Nexus is the way I describe it is it's a people-powered alternative insurance mutual built on Ethereum. So run by smart contracts, launched in 2019. And I think you all have an impressive track record. I mean, you boast nearly, I checked today at nexustracker.io, you have about 60 million in active coverage. And then there's about 100 million in ETH in the capital pool, which is what enables the mutual to offer such coverage. So anyways, Hugh, I don't know if you'd be ready or comfortable to share your screen too as we walk through this, but love to kind of just show people how that works and why it's so important to DeFi.
Yeah, cool. No, thanks. I think, just very quickly, Nexus is basically a DAO. I'm very close to that, but members pool their money together and then they decide as a group what to do with it. And in our case, that's sharing risk with each other to protect the community from I guess bad things happening. And we think that that's it's going to help DeFi evolve and help crypto evolve more generally. But I think it's quite cool because everyone is kind of in it together as a DAO. All the tasks, everything that the mutual needs to operate is kind of done by the members of the mutual. So it's really kind of taking insurance all the way back to its roots, doing what it used to do hundreds of even thousands of years ago, but we're just doing it with new tech in a scalable way. So anyway, that's the kind of real crux of what we're doing. But yeah, since we launched in 2019, our first product has been smart contract cover. So basically protects you against hacks in smart contracts, bugs and things like that. So like, the DAO hack, parity issues, BZX issues, there's a whole massive string of them and they keep adding up. But that's kind of been our first product. We've had some great success with that so far. But I guess last week we launched our second product, which is custody cover. And as you mentioned, it's to cover against like basically CeFi providers. And we've started with the CeFi lenders, like BlockFi, Celsius, Nexo, HODLNOT, and a few others. So that's a big step for us because it's kind of shows the flexibility of the Nexus platform, but also it's hopefully helping the crypto industry more broadly manage risk in a way that the traditional insurers aren't able to do right now. So we're really excited to get this out there.
Hugh, what is the difference between the new custody cover and the historical smart contract cover that you offer?
Yeah, so basically, this is kind of like DeFi cover versus CeFi cover is probably a good way of describing it a bit differently. So like DeFi, your money is actually being held by smart contracts. And so you're effectively trusting that those smart contracts operate as intended. And so, if there's a bug, then you could lose your money. So that's basically what smart contract cover does. With custody cover, you're essentially giving your crypto over to centralized providers and they take care of it for you and they store the private keys and they have rights to do whatever they want. I guess with some of these providers, they out lend on the funds and etc. And so they're taking a variety of risks in and of it themselves, not just custodying those funds. And so custody cover essentially covers all things related to that provider. So the cover would pay out basically under two conditions. One, where if the custody provider requires you as a user to take a haircut of more than 10% of the value of your funds. So basically they force you to take less than you had deposited with them. Or secondly, if withdrawals from the custodian are blocked for 90 days or more, so if they just go dark, something happens, someone gets taken by some government and can't access withdrawal keys or something like that, which does happen. So there's a whole bunch of reasons, but that withdrawal kind of I guess trigger or claim event trigger is kind of like the catch-all. Basically, if the whole thing blows up and you're never really going to get your money back for whatever reason, then that's what the claim would be triggered under.
Yeah, this is definitely much more extensive coverage than smart contract cover, because we've always, when a bug comes up or when an exploit comes up, whatever it is, that's been the conversation in the mutual is this a bug or not? This coverage for CeFi is really much more of like a blanket coverage that, I would liken more to insurance. I don't know if you properly call it that. Smart contract cover, I know we always would like correct ourselves and say, well, it's not insurance, it's smart contract coverage. This feels more like blanket coverage against the worst case scenario happening in BlockFi and Nexo and Celsius.
Yeah, exactly. I mean, all cover the mutual provides, not technically insurance, it's called discretionary cover. That still applies. I guess the terms here are quite broad. We did that deliberately. I think one thing on smart contract cover, which we are also looking to change and enhance, is the fact that we designed it when the risks in DeFi were kind of known, and that was the most obvious thing. But they've obviously changed and morphed since then, and so we do need a bit of an update. And we actually have some new products coming that will be much more comprehensive on the DeFi side as well. Basically, we're in a new industry that moves pretty fast, and we've obviously got to keep up as well. And so that's what we're looking to do.
I'd love to learn more about like what you can share of those new products, but also like if you can reflect it all on like the last 6 months, because I mean so much happened. We were in the spring, and Nexus I think was at record coverage, but obviously things exploded after Compound started the yield farming program, or what we'll call liquidity mining, I think is the proper term they use for it. And I just, I want to call out, like, there was a tremendous amount of growth that happened over the summer. It was very fast. But anyways, like, what lessons do you draw from all of that? And then if you can tell us more about what these new products are.
Yeah, so I guess just before DeFi summer really kicked off in the yield farming craze, Nexus had about 4 or 5 million of assets, was covering like 1 million or 2 million of cover and those types of things. And so people were playing around with the system. We paid out some claims. We were just trying to work out how to grow this thing. We knew that there was a lot of demand there, but we didn't have enough capital in the mutual to actually meet that demand, because it was a bit of a chicken and egg challenge. Then yield farming kicked off. We saw a lot of influx of demand. We changed a few mechanics on the fly kind of thing to kind of capture more of these inflows into DeFi. And we grew the capital pool, and it's now up to 100 million in the space of 4 or 5 months, really. And at one point there, we had cover outstanding of over 250 million. And things have quieted down a little bit then, because some of that was farming related. But it really showed that people actually want the underlying product, and which is great news for us. And now we're in this position where we have a sizable capital pool. We're able to get out there and offer meaningful coverage levels to individuals, but also to funds who perhaps a bit more risk aware than your average DeFi user is playing around a bit. It's been a great phase for us. I guess moving on to your second part in terms of the new products. One of the things we're looking to do, and we still need a better name for it, but we're looking to release a stacked risk cover. So the idea being that if there's a protocol which is represented by a token, for example, like a YETH or a YDAI or something like that, where it's kind of composed of a whole bunch of protocols underneath, we can give you an option to essentially swap the YDAI for So one YDI for like 90 cents worth of DI at any point. And so therefore, the idea being that that we cover, doesn't matter what the risk is, if any of the stack underneath that protocol, underneath that token fails for whatever reason, whether that's Tether falling over or whether it's a smart contract bug, basically anything within that stack, then we can provide cover for it. And another really interesting aspect of what you can do with this type of product is cover tokenized staking positions. So obviously ETH2's launched, people are starting to stake. There's professional staking services coming out there that are going to start releasing their own derivative staking tokens that effectively earn yield, and you can trade them and things, and they get around some of the, obviously the lockups and the 32 ETH minimums and all that type of stuff. But you're also trusting that provider to run their nodes and run their validators correctly and all of that, and handle the withdrawal keys and all of those types of risks. And so what we can do there is effectively cover all of that in one nice little bundle. It also includes effectively cover for slashing risk that builds up over time and things, because you can essentially swap your staking derivative for ETH underlying if the pricing gets out of whack too much. So it's basically comprehensive cover, and it's a very flexible aspect that we're hoping to we're going to be rolling out in the new year.
Yeah, in terms of the coverage then that you're offering, how does that differ from more recently we've seen Cover Protocol launch? I'm trying to think if there's any others that I'm leaving off that are already live. I think Cover rightfully probably deserves the most attention there. How is Nexus and Cover similar and different in terms of, I guess, the way that you offer insurance, and then also, I guess, I don't know if there's any pros or cons we want to call out. Not necessarily like why one is better than the other, but just kind of calling out the differences since it's newer.
Yeah, sure. So I think Cover's basically, it's very similar to a prediction market where you create like a claim, no claim. Someone provides liquidity, creates a claim, no claim token, and then you can trade those claim, no claim, no tokens on Balancer and work it out. So, and then if an event happens, then if you're holding the claim token, you can get cover. So it's quite effectively, Nexus runs one capital pool that's spread across all risks, right, whereas Cover runs a prediction market on each individual risks on a separate basis. So that has its pros and cons. From our perspective, obviously we like our model better, but I'm sure the Cover guys like their model better. So there are differences there.
What's worth calling out there, and this is something that they could be amending in the future, is so I stake NXM to offer cover across like 20 different applications, and when I do it, I basically hit deposit on however much that is. So it's about like, how much am I willing to risk first off, because I could lose this if there's a claim, and then I'm applying that capital to each and every one of these pools. So it's like me just kind of clicking through these, and yeah, like I think with Cover, I was actually talking with them online the other day about this. I think it's DeFi Ted is his name, and anyways, we were just saying like, oh, if they can find a better way. Basically, I was trying to mirror what I really love about Nexus, where you just sort of click through. But I think the reason I want to call this out, what I'd be excited for is, I think with Cover and Nexus, and there will be more that come in the future, we want to see more insurance mutuals or insurance protocols succeed, because then they can insure one another. And like that to me is like I think it's like, I don't know, I guess, how Nexus has operated previous to having that sort of coverage. But I think in the near future that we'll have a pool in, like, let's say a Cover, and maybe eventually we'll have something in Nexus covering Cover and so on. So anyways, like, any thoughts on like what we need to get to that like reinsurance or insurance for insurance?
Yeah, so I think it's going to be an important development once we get there. I mean, if you think about the space more broadly, it may actually make more sense for the reinsurance or some sort of insurance layer to be outside the entire ecosystem from a risk point of view, because it's completely independent. However, I like internal solutions that are just as robust. I mean, ideally, that's where we get to, right? So, supporting each other and making sure that we can cover each other in terms of if something goes wrong, that's a great thing to be in. And we've provided cover on open as an example, and I'm sure we'll probably release cover for cover in the near future as well.
Absolutely. Yeah. If anyone's unaware of Open, it's OPYN, and they are DeFi on-chain options, but we commonly talk about it as protection in the same way that you would think about smart contract cover. Hugh, would you mind sharing your screen if we could see what this custody cover looks like? Because it's so simple to use, and I want to, I really am hoping that we can help those that are maybe newer to DeFi eventually understand how to use this, because it's a great way to get exposure to the benefits of DeFi, because right now I don't know of any insurance against these custodial services for lending, which is the most popular to me is BlockFi and Celsius. So anyways, I'll let you take it away from here.
Yeah, I'll just quickly show you the basics here. But so this is where you can buy cover on all the various protocols that we offer cover on. So you can choose between the smart contracts or the custodians. So I'll just select the custodians for the sake of this. So we've got 6 listed for now. I think one thing that people may not be aware of, there's a whole lot of custodians out there that we haven't listed just yet, and we'll be starting to release them in waves and stuff like that. So centralized exchanges and all the rest of it, there's a lot coming. But if you want to get cover, say on BlockFi, then simply just select it. Say you want 100,000 of DAI for 60 days or something. Then it just gives you a quote, and then you can go from there and make a few declarations about, just you understand what the cover is and all that type of stuff. And you can see here for, you can just pay your premium straight up, or pay your cover cost and go from there. And then you just.
And Hugh, that is, when I buy cover, it's a minimum of 30 days, right? Minimum.
Yeah, that's right.
Days. So I mean, when you see the rates are, if you were to pay this for 365 days of cover, but you can actually buy as much as you want, just minimum of 30 days out to, gosh, I'm trying to remember, does it go out? It normally goes out a little bit past a year.
Yeah, we've got it at a year now, basically. So and you can obviously renew it whenever you want. So yeah, it's kind of as flexible as you want to make it there, and you can line it up with whatever terms you've got with the centralized provider.
Yeah, and then are all the payouts here is it DAI or Ether?
Yeah, so you can choose. I chose a quote here in DAI. You could choose to buy cover in Ether, for example. Instead, so if you were depositing Ether with BlockFi, then it probably makes more sense to buy the cover in Ether, and you can go from there.
Absolutely. Okay, great. Well, I think that's about everything there. Is it possible to, wondering if we should call it anything with staking that's newer? I'm trying to remember some of the updates over the last few months. If you are staking NXM and providing cover in Nexus Mutual, how often are you claiming those rewards?
So the regular rewards actually get distributed automatically. We kind of do that behind the scenes for everyone. So
I didn't even realize that. That's good. Gosh, so
that happens. That happens every Monday. That's great. There are additional bonus shield mining rewards that come up every now and then, which is kind of promotional stuff, and they have to be claimed manually once per week by yourself, by whoever's staking. It is a bit different, but the base rewards are all distributed automatically.
Awesome. What can you share about the mutual putting the $100 million of Ether to work?
Yeah, this is actually a really exciting update. So right now, I mean, insurance companies, if you step back, basically make a lot of their money, sometimes even more than half of it, on investment earnings on the float or the cash pool that they've got. So it's a critical part of what we want to do at Nexus. We haven't enabled it just yet. Basically, the pool's pretty much just salting Ether. And so we're going to release an update soonish that will start putting this capital to work. So firstly, the members of the mutual have to decide what to actually do with the assets, and there's a couple of options out there, but I think one of the big options really is going to be getting involved in staking returns on ETH, and that's going to start putting that ETH to work, earning a yield. We also want to make sure that we're not kind of covering the same thing that we're putting our assets in, because then if something happens, then we could lose assets and pay claims and be in quite a bad spot. So we have to be cognizant of that kind of accumulation risk, but it is really going to be really important for the mutual and add a lot of value to the membership base, because now we've got active capital rather than it's earning investment returns plus surplus rather than just surplus from but essentially surplus is premiums less claims.
Okay, so at the moment, the pool is mostly Ether. It's like 99.9 something percent all Ether. There's a little bit of DAI in there still, but I totally forgot about that. That like obviously we're at that point we're in an inflection point in the history of Ethereum where you can now stake. We haven't seen all of those staking services launch yet. I think like Rocket Pool is one of the most obvious ones because you can deposit Ether and withdraw it at will. So I'm wondering, like, can you share at a very high level, like the boring business of gauging the risk and like basically like if you have 100 million in Ether, I'm just wondering if you can give some examples of how you assess like, well, how much Ether can we put in based on how much coverage we currently have and understanding whatever risk might be there and using something like a Rocket Pool.
Yeah, so I think the first step is working out if we're also covering it on the claims side. Mm-hmm. And if we do, then we probably want some lower caps than if we don't. So that's first one. And then secondly, I mean, just in general, the kind of approach that you should be taking with assets is a much more conservative approach because the primary purpose is that they're there to pay claims. So you don't want to put them at substantial risk. So you're more happy with like a reasonably certain yield type approach. So that's why staking makes a lot of sense. So once you kind of got that broad category, then it's about choosing the particular one, and you want to make sure that, well, one, you're confident in them, two, that you're not overly exposed to them, so that if they do go down, you're not putting the entire mutual at risk. So there's probably a little bit of diversification at play. So I think in general, the way it's going to work is we'll pick, once some of these providers start coming out with their tokenized staking positions, we pick a couple of them, start allocating reasonable but not huge sums to them, and then see how it goes and build up from there. And so I think it's going to be much more of a gradual process rather than, okay, let's just go all in, because that doesn't quite make sense from where we are.
Yeah, and when would we expect that to go live? Is there any expected release date?
Yeah, well, I'm hoping before the end of the year, but audits are audits, so we'll see how it goes.
Yeah, that's totally fair. One other thing I wanted to cover is, so we've talked about buying coverage. We talked a little bit about staking. There's also just having skin in the game in terms of owning NXM, which is, it's something that I do. So full disclosure, obviously I have some bias here and maybe I have a conflict of interest anytime I talk about anything I hold. But I had been using Nexus since I think November 2019, basically was using it to insure all of the assets that I was holding, especially in places like even Uniswap. I had some liquidity provisions with synthetics and I was scared out of my mind that something could potentially happen. So I used Nexus to protect me against bugs. Eventually, anyways, this summer, I personally decided that I wanted to actually help to provide more cover, because I was seeing the conversations in your guys' Discord that it was like, we need to scale quickly and offer more cover. And the one way to do that is you buy the NXM token. So I'm not endorsing or recommending someone buy this, but this is a part of actually offering cover. In doing that, I'm wondering, can you explain this minimum capital required percentage? Because it's crucial to the way the NXM token, which is on a bonding curve, this is essentially what's driving the price up and down right now. And I just want to make sure people understand that, so that, anytime you have to buy something to participate in a DeFi mechanism, like I always like try to do my research. So anyways, if you can talk me through some of the tokenomics of the minimum capital required.
Yep, cool. So I start with the high level objectives first. That's kind of why it exists, why we've done the bonding curve. And basically what the mutual needs to do is it needs to have enough capital so that it's confident, very, very confident that it can pay all claims. So not we don't fully back it, we're not 100% collateralized, but we want to make sure that we're very, very confident that we can pay all claims. So that's the first thing. And so the second thing is we want to make sure that we don't have too much capital, because we don't want to be sitting on dead capital that's inefficient. So the minimum capital requirement is basically how much we think we need to back all the covers that we've got in play. And so as we grow, the minimum capital requirement will start increasing. But for the sake of argument, we'll just assume it's a fixed value for the current state of where we're at. And so then the next important concept is the minimum capital requirement percentage, or the MCR percent, which is basically a ratio of the funds that the mutual has versus the minimum capital requirement. And so that's basically saying if it's over 100%, we've got more funds than we need to kind of operate. If it's at 100%, then we've got just enough that we need to operate. And so what happens is, as that MCR percentage gets further above 100, the price, as according to the bonding curve, goes up quite steeply because it's on an exponential. And the whole reason there is saying, look, we've got too much capital. We don't need that right now. Please destroy your NXM tokens and take some ether out, and it's fine. I love
you have the same thing that my kids just happen to not be near the door right now, but this is normal. Anyways, keep going, Hugh. So I think it's hilarious. Like, this is
yeah. They're doing their thing in the background.
Yeah. Bring them on screen here. They can help explain all of this.
They can help explain all
the. By the way, as you're talking through this too, like, I think of this MCR percentage as it reminds me a little bit of, but it shouldn't be likened to an equivalent of a collateralization ratio, where it helps to give us confidence that the mutual can pay out all cover. Because that's the end of the day, you can't become insolvent. I mean, we have to be able to pay out all cover, even though probabilistically it is it's almost impossible for all of these to fail at once. But anyways, keep going though with that.
Yeah, and that's the main point. So when, if we have a few large claims, then our funding ratio, our solvency ratio, whatever you want to call it, that drops down, and that means the price drops down, and so encourages more people to put more money in to recapitalize. And so that's kind of the important mechanism we're doing here. So it's all designed around making sure we've got enough capital, but not too much, and that we attract more capital when we grow. So when we write more and more cover, then the MCR gets higher and higher, which dampens the token price to encourage more people to put capital in, and so we can start growing and selling even more cover after that.
Yeah, because the only way the capital pool grows is people are buying more cover. That's really good for them. That's the mutual doing its job, or people are putting more ether into the capital pool, which it means that someone has bought the NXM token from the bonding curve, and so both of these. It's such like a flywheel. Like, once it took me really some time to understand this, but if you're putting capital in, it means you're enabling the mutual to offer more cover. If you offer more cover and people buy more cover, and it sort of like builds on that idea. If you're not offering more cover, if you're not attracting more capital over a long period of time, then sure, it doesn't make a whole lot of sense. But can you share some of the milestones too? Like since July 2019, I mean, it's been a relatively short compared to most things in our life. In DeFi, it's a long time, but I mean, you guys you were chugging along there, and then like really you exploded with what happened over the DeFi summer.
Yeah, exactly. So I guess a couple of stats. Yeah, so like we had about 4 million in the capital pool. We went up to about 100 million. We'd written about 500,000 worth of like premiums or cover contributions, and that's gone up to like 3.5 million by now. And so it just like basically just shifted massively for us, which has been great. And I think one of the things that like really that means gives me confidence we're on the right track is like this past weekend I come in on a Monday and there's been like 450,000 worth of cover purchases, like Balancer and YN and stuff, and so like real substantial funds and like people are trusting us that they believe in the system enough to put money in it and like really take on risk on the other side, knowing that they're backstopped by Nexus. And secondly, that they've they're doing that, and secondly, it's a fund. Like there's most likely funds or people managing other people's money, and that's kind of a next step up in terms of sophistication of people getting involved. So I think that's a real strong indication we're on the right track here.
Yeah, it's also another example in DeFi where I have learned more about insurance and how it works from Nexus because of the transparency that goes into building the best DeFi applications and protocols. I won't say all of them, obviously. There's some out there, but it's just cool. Like 3 years ago, like I couldn't have cared less about insurance, and it's something I had on like a car, or you have it on a home. But now I recognize, like, wow, like now I get why, at least in the United States, I know of like the big names in insurance, like why they are so big, why they're important, why they grow, how they function, even like some of the costs that go into it. But when you build something on Ethereum like this, you have cut out so much overhead costs, so much middlemen. I mean, you guys are totally remote as well, right? The whole team is remote. Yeah.
Yeah, exactly. It's a complete paradigm shift. I think it's really amazing. I mean, I used to work in insurance companies, and I used to be in the finance area as a CFO before and stuff. And I guess one example for me is like it took us 3 months to get out year-end numbers, so you knew what the financial position is. And here we basically have real-time reporting on everything that anyone can look at. I show my old colleagues the tracker sites and stuff that they get amazed at like the information that's available. But then the thing that really blows their mind is when I say, well, but we didn't even build that. Someone else built that, and they can. And it's just like a complete paradigm shift, and people they can't quite get their head around it, to be honest. So yeah,
it is. It's it's a testament to. I think it's a testament to what you guys have built. But it's also a general testament to DeFi and which is really a niche community that mostly is on Ethereum. And so, yeah, it's just been really exciting to see all of this. I mean, the total premiums paid here, like these are some of the numbers that are really interesting to me to see, like these numbers going up over time. Active cover though. So one last thing I wanted to just mention here is, while Nexus exploded with growth, like everything, it also rightfully has, things have cooled off a bit. But what's really interesting is while at one point, I think we had 200 million in active cover, and now there's around 60 million, which was also driven by an insane yield farming program at the time. To be fair, it's kind of like measuring from $19,000 Bitcoin in 2017. It was there for like a moment in time, and then we came back down to reality. I think it's just interesting to see that sort of growth. But the mutual, despite like the cooling off period, it can still continue to offer more and more cover. There's a lot more capacity to offer more cover right now, right? I mean, I don't know if how much more cover could the mutual be offering? It's at 60 million. There's a $100 million capital pool. Am I right to say like there's $40 million of potential coverage there, or is it a little bit less?
No, you can go to 300 million.
Oh,
we can get.
Wow. Okay. Yeah.
Well, actually, no. Hold on. Wait a minute. 100 million times. No, we can get to nearly 500 million. So that's one of the beauties of insurance like mechanisms. Like we actually gear this thing a lot. Like to give you the gearing that we can get right now is 4.8. That's kind of our gearing factor. So we're nowhere near that level right now. Mm-hmm. But like big, huge insurance companies will gear it like 50, 60 times. So that's the model. And that's why it's a bit different to a fully collateralized prediction market approach. However, like that's real. That I think this whole DeFi, yield farming and stock craze. One thing that Nexus took away from that is we were always in this position before where there was heaps of demand for cover and we didn't have the capital to support it. And now we've got the capital to support it. And now it's going to be about building out distribution and demand. And so it's really, from a team point of view, it's really flipped our focus around the entire 180 degrees, basically, which has been great because now we can really focus on the demand side of things.
Hugh, I got one more question for you. It's from Peter. What would you like to see the community have on top of Nexus? There's some bounties you posted for the upcoming Gitcoin hackathon. Also, too, he did say King Karp Hail, fresh new UI. Okay. Anyways, but any thoughts on this question?
Yeah, so we actually have 2 Gitcoin bounties up there. One is actually to build a reinsurance layer on top of Nexus. We think there's a relatively simple way of building a potential reinsurance layer. And a second one is to build new tokens that are naturally covered tokens. So they're yield-bearing covered tokens. So, for example, you could build a C die or an A die that has built-in Nexus cover and create a new token. And that would be really cool from a UX point of view because you don't have to then buy a whole bunch of two different things at once. You can just get the underlying product in one go.
Very, very cool. Yeah, I know. I'm excited for is it ArmorFi that's building on top of Nexus, and they might launch in December, they might launch later, but point is they would be another distributor. And there's all sorts of cool things they're trying to do, like streaming payments. Like that would be a great way for someone to buy way less than 30 days of coverage. And so, I think like my key takeaway is like everything I've kind of learned from you and Nexus is that it takes time to build a robust system like this. And insurance cannot follow some of the practices of other DeFi yield farming type like mechanisms, because at the end of the day, like you're the safety net. And so anyways, it's been really, really fun to watch it all. Like I've probably learned about as much from Nexus as any other DeFi app. And I don't know, I think that's why I talk about it incessantly. I've heard Vitalik say in fall 2019 at an Ethereal, I think it was him and Joe Lubin both said that insurance was one of the most important linchpins in us like being successful. So, it feels like we're getting there. And I didn't realize all these like new mechanisms coming through Nexus. So excited to see that. Hugh, if someone wants to build on Nexus, how should they reach you? Hop into the Discord group, or do you have an email?
Yeah.
Twitter?
Yeah, the best one is go on Twitter or Nexus Mutual, and then jump into our Discord from there, and then we'll pick it up. And we're pretty active in there.
That's it. Yeah, I was gonna say, like every great team, you guys are so active in Discord, and you're almost overly accessible there. So yeah, if you want to build on there, do it. God, your kids are so cute too. Well, Hugh, thanks for staying longer with me. I'm going to end the broadcast here. You're more than welcome if you have any questions after this. But everyone, I'm actually about to hop on Crypto Banter with Ran, who I believe I don't know if the show is still live, but it's called a Crypto Trader on CNBC is what he used to call it. I think he renamed it to Crypto Banter. I guess I'll find out in like 10 minutes here. So there's that. And then tomorrow we will be back with another episode with Tasha from Alpha Finance. So that should be really interesting to learn about. Other than that, hey, thanks so much, Hugh. Tell Kaylee and the rest of the team I said congrats and hi. And bye, everyone. Have a great day.
Thanks, everyone. Bye.